Welcome to the Great Divorce Podcast, hosted by divorce financial analyst and retirement planning counselor Andrew Hatherley. Join Andrew and guest experts as they help late-life divorcees build the financial and mental foundation for a meaningful future. There is life after divorce. Now, on to the show.
Hello, everybody, and welcome to the Great Divorce Podcast. Before I get into the very timely subject of stock market volatility and gray divorce, I just wanted to spend a couple of minutes letting you know about a new book that was just released that is a great resource for those of you who are either considering divorce or are already in the middle of the process. Or maybe you just have friends, family, or colleagues who need to be educated about the divorce process. Regular listeners of the podcast, or those of you who follow me on social media like LinkedIn, or follow the Great Divorce Podcast on YouTube, Facebook, or Instagram, will know that I recently had the great privilege of contributing 3 chapters to a book called Divorce Amicably, Your Roadmap to Resolution. This book was put together by a colleague of mine, Tracy Ann Moore Grant, the founder of the Amicable Divorce Network. Now, if you want to find out more about the book, just listen to episode 63, in which I interviewed Tracy and we talked about the book's origin and ultimately its gestation to the point where it more than doubled in size. Eventually, the book came out to 423 pages, covering more than 80 topics with contributions from 40 divorce professionals. It would have been even longer, but the very disciplined editors managed to reduce the length of contributions from people like me down to the bare essentials. The 3 chapters that I contributed to the book deal with gray divorce, achieving the best financial results in divorce, and rebuilding financially after divorce. Now, the book, Divorce Amicably, is available to purchase on Amazon. The Kindle version is $10, the paperback version is $30, and the hardcover is $35. Given that I am a featured author in the book, I will admit to having several copies in my garage. Rather than sitting in my garage, I thought I'd give some of you listeners the opportunity to get a copy of the paperback version completely free of charge. What's the catch, Andrew, you might ask? Well, it's true I don't have an unlimited supply of books or an unlimited postal budget, but I am prepared to mail a free copy of the book to 3 lucky people whose names will be pulled from a hat. Well, not really a hat, but will be drawn on May 5th, 2025. What do you have to do to get into the drawing? Very little. Just email me at andrew@wiserdivorcesolutions.com with your name and mailing address, and if you're one of the first 3 names pulled from the hat, the book will be airmailed to you. Okay, great. Now, on to regularly scheduled programming. I want to talk about some of the recent volatility we've seen in the stock market. Really, we've seen some crazy swings over the first half of April. On April 2nd, the Trump administration announced some pretty aggressive tariffs on foreign countries, which led to the S&P 500 stock market index dropping over 10% in the 2 trading days following the announcement. Well, it's been a roller coaster, and a week later, on April 9th, a 90-day pause was announced on these tariffs. That led to a very strong stock market rally of 9.5% in just one day. Since then, the market's been bouncing back and forth to various headlines relating to these tariffs. It's not just the stock market that people are concerned about. many economists are starting to utter the S word. I know many of you listeners were around in the 1970s. I hit my teens in the 70s, and I remember hearing the S word, which is stagflation. Well, a lot of economists are talking about the possibility of stagflation returning. What is stagflation, you might ask? Well, it's a double whammy. It's a combination of the words stagnant and inflation. An economy that's suffering stagflation means little economic growth and rising unemployment, but at the same time, prices are rising. Dealing with a bad stock market and stagflation is stressful enough for many of us, but when it coincides with the economic and emotional stress of divorce, which we've mentioned many times on the podcast can be the largest financial transaction in your life, people understandably get worried and can panic. The decline in economic growth may mean it's more difficult to find a job, and the jobs that people do have may see a freeze on salaries. And if this happens at a time when prices are rising, well, that's going to put a lot of strain on a household budget. If a couple gets divorced, resulting in two households, the financial stresses are obvious. It may even cause people to delay getting divorced. And in some cases, that can make sense. In other cases, it just makes the financial impact of a divorce that can't be postponed even more difficult. I get lots of calls from clients basically asking, in the middle of all this stock market roller coaster, what should I do? And I'll tell you how I answer that question, but first we need to distinguish between my two types of clients, because I have two businesses. My business, Wiser Divorce Solutions, helps people before and during divorce. It's a relatively short-term relationship where I'm working with my client and their attorney to help them reach a marital settlement agreement that'll put them on a solid foundation for life after divorce. My investment advisory business, however, which is called Transcend Retirement, is a long-term relationship. And here I'm helping people manage their retirement investments after divorce. And the relationship between myself and my clients can last for many, many years through that person's retirement. As my client's long-term investment advisor, the answer to their question of what they should do in a crazy stock market is pretty easy because we've already built a plan based on that person's unique situation, their goals, their time horizon, and their risk tolerance. Because we have a plan, my response to their concerns about market volatility is usually to revisit the plan and understand why we put it together in the first place. Because one of the first conversations that I'll have with an investment advisory client is to remind them that the occasional volatility that we're seeing now is to be expected in the stock market. Whether it's the Black Monday stock market crash of 1987, the dot-com bust of 2000 to 2002, the housing and bank crisis meltdown of 2008-2009, the COVID crash of 2020, or the current Trump tariff tremors of April 2025, there's always going to be moments of crazy swings in the stock market. But of course, the trend over time is up, and stocks typically have returned an average annual rate of about 10%, about twice that of bonds, because there's more risk in stocks in the short term. Now, because most of my clients are in their 50s, 60s, or beyond, we understand that they don't have the time that somebody in their 20s does to ride out a big drop in the stock market. So most of my clients have very well diversified portfolios. What that means is that they're invested in a combination of different types of stocks and different types of bonds, so that when the stock market goes down sharply, Their accounts may go down, but they're not going to go down as much as an investment portfolio that's more heavily aggressively invested in stocks. Now, on the other hand, if the market goes up sharply, their portfolio will likely go up also, but not as much as a more aggressive stock-oriented portfolio. So, with my investment advisory clients, there may be ups and downs in their investment portfolios, but they're not going to experience as sharp a roller coaster ride as a market index like the S&P 500. The beauty of the diversified portfolio is that an investor is more likely to stay the course. Not only are they more likely to stay the course and avoid panic selling, but they're more likely to follow the most famous, or one of the most famous adages of the stock market, which is buy low and sell high. It really is a beautiful thing when you can look at a stock market dropping 10 or 20 or even 30% and see it as an opportunity. But that comes from establishing a good core portfolio that's based on your unique needs and risk tolerance and goals. Now, when I'm dealing with clients through my divorce consulting business and I'm not their investment advisor, well, I see all sorts of things in their investments that come across my desk. They may have their own investment advisor, or they may not have an investment advisor at all. They may have a great investment advisor, or they may have a really lousy investment advisor. They may have money in a 401k that they haven't looked at in 20 years, or perhaps better stated, they haven't adjusted it or rebalanced it in 20 years. I see couples in their 60s or 70s, a year or two away from retirement, with investment portfolios that may have 80 or 90% in stock investments. And sometimes a huge chunk of their retirement accounts is in a concentrated position of one stock. I don't need to tell you about the risk that carries. When I'm working with a client going through divorce and I see an investment portfolio that really may not be in their best interests in the long term, I'll discuss that with the client and their attorney with a view to the client's long-term security. In many cases, we'll need to have a conversation about resisting the urge to react emotionally to market swings. And panic selling often leads to long-term financial regret. There are a couple of tips to consider when dividing investment accounts in divorce when the markets are going through wild swings. The first is to consider dividing the account between you and your soon-to-be ex on a percentage basis as opposed to a fixed dollar amount basis. Consider a $1 million brokerage account. Consider the implications if the marital settlement agreement has the husband getting a $600,000 fixed amount from the account and the wife getting the rest. What if the account drops 20% in value? In this case, the husband would still get $600,000, but the wife would only get $200,000 as opposed to $400,000. Now consider if the settlement agreement had the husband getting 60% of the account and the wife 40%. In this case, if the $1 million account value goes down 20%, the husband will get 60% of $800,000 or $480,000, and the wife would get 40% or $320,000. They would essentially share in the losses of the account. Of course, on the other hand, if the account were to rise 20% in value, they'd share in the gains. In a regular brokerage account, there may be tax consequences from panic selling. These sales may trigger capital gains. Taxes are something you need to make sure is factored into your marital settlement agreement. In a tax-advantaged retirement account, capital gains aren't a concern. However, when you're taxed when you withdraw funds from a traditional IRA or 401k, and I've discussed this many times on the podcast that $1 in a regular brokerage account is worth more than $1 in an IRA, which will eventually be subject to a higher ordinary income tax rate. If you're going through divorce, or if you just finalized your divorce and you're concerned about your retirement investments, I'd be happy to chat with you. Shoot me an email to andrew@wiserdivorcesolutions.com, and we'll schedule a free 30-minute consultation. And don't forget, use the same email address if you're interested in entering the draw for a free copy of the book, Divorce Amicably, Your Roadmap to Resolution. Until next time, take care.
Thanks so much for tuning in to this episode of the Gray Divorce Podcast. To learn more or get in contact with your host, you can visit Andrew's website at transcendretirement.net. Also, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. That helps others find the show, and we greatly appreciate it. Thanks again for listening, and we'll catch you in the next episode.
Information provided is educational only and should not be construed as legal or tax advice. Each situation is unique and should be discussed with your tax or legal advisor prior to implementation. Andrew Hatherley is not an attorney and does not provide legal advice. Information provided is financial in nature. Advisory services offered through Hatherley Capital Management, LLC. Divorce financial analysis services offered through Wiser Divorce Solutions, an affiliated company.